And then let's talk about Happiest Minds. They had come out with their Q4 earnings, and if you look at the way how the picture looks like, their dollar revenue saw an uptick of 15.4% on a quarter-on-quarter basis. Their revenue was higher by about 14.5% on a quarter-on-quarter basis. However, their PAT saw a decline of about 14.5% on a quarter-on-quarter basis. But let's talk more about the earnings and the way forward going ahead for Happiest Minds with their management. We are joined by Venkatraman Narayanan as well as Joseph Anantharaju of Happiest Minds. Good morning, gentlemen, and thank you for joining us on ET Now. First of all, congratulations on a strong Q4 for Happiest Mind. Could you tell us what actually led to this strong performance?
As we have been saying right from the beginning, the demand situation for digital IT services across the entire digital spectrum has been kind of expanding at a very rapid pace, and that being exactly the area that we are working in, we are able to grab as much as is coming in our direction. So that's really driving the expansion in our revenues. Second thing is also we have had this acquisition of Pimcore Global Services that we did last year, and which concluded early part of Q4. That's been integrated very well, and that's also in a hot e-commerce area. That's also adding to the demand, and that acquired business is also doing pretty well. So if you give me an overarching picture on the demand, very healthy, both from existing clients and new clients. We have added about 23 new clients this quarter, and about 8 of them billion-dollar corporations. So all of this is adding to the expectation for more work to be delivered by Happiest Minds.
And just giving some color, to the growth that Venkat was talking about, the heartening factor is that it's been quite broad-based. If you look at all our geos, they've exhibited growth Q4 over Q3, and our verticals as well have, across the board have grown. A couple of things I wanted to call out. Middle East, as you would see from our fact sheet, has grown as a percentage of revenue from 4 to 8.2%. This is driven by one large customer out of Saudi Arabia that grew quite well in Q4, and a customer from the PGS acquisition, which again ramped up quite well. That's based out of UAE. Europe also has seen good traction. We had 4 new logo closures in Europe, UK, and the percentage of revenue ticked up from around 10.2 to 11.7%. And FY20, at the end of FY20, this number was 7.2%. It's around 11.7%. So that's a good improvement. It's also helping us in diversifying our revenues.
Gentlemen, in the press release, Executive Chairman Ashok Soota has been quoted as saying that the aim for the company will be to achieve 20% organic growth as you start FY22, as was indicated at the time of the IPO. Which vertical and which geographies would contribute to that 20% growth? And also, what's the plan with regard to inorganic growth?
So, I'll take the first part of the question and then let Venkat chime in on the acquisition, and the growth that we would expect. But if you look at the geos, we expect that again to continue the Q4 trend, that all the geos will contribute to our growth. But we do expect Middle East and Europe to exhibit a higher growth than they have in the past, and for that percentage of revenue to tick up. If you see Europe, more of our revenues come from UK, and their response to COVID is in an advanced stage. They have more than 50% of their population vaccinated. Business is beginning to open up, so we expect demand to tick up out there. Europe also, US also is looking good with vaccinations at around 45% to 50% of the population. There's a fair bit of optimism. And as I mentioned, UAE, we have a couple of marquee customers which we plan to build around. In terms of verticals, we're luckily not in the verticals that have got impacted by COVID. I think the verticals like travel, transportation, hospitality, it's going a little up and down. There is an improvement in demand, but it's still going to take time, I think, and we are not in these verticals. So we expect the verticals that we are present in, the edutech, high tech, retail, CPG to continue driving growth. I want to call out retail because the PGS acquisition that we did, 80% of their customers were in the retail space. So we've got a good set of logos to build upon and expand in with some of the services that are non-e-commerce around analytics, IoT, and other offerings that Happiest Minds has to augment the e-commerce offerings. And at the same time, the capability that we're getting on Pimcore and e-commerce, we will be able to take it to many of our other customers. So I expect retail to contribute increasingly more during this year, but we expect growth across all verticals: EdTech, industrial manufacturing, digital media, high tech, retail, and CPG. Venkat, you want to take the question on acquisition?
Yeah. So if you look at it, Ashok's statement was largely on the organic growth part. So this has been kind of an aspirational number that we have put out there. Looking into FY22, evaluating the demand situation, that looks very plausible. So 20% organic growth is something that we want to continue to do and keep maintaining in the near to the medium term.
Venkat, coming to you on this next one, margins expanded on a year basis, but they've contracted on a sequential basis. What led to that contraction, and what's the outlook going forward in light of what we're seeing?
On the margin outlook, if I can take that part first, we have been always, I would say, guiding or suggesting that it would be in the range of 22 to 24%. Have been proved wrong this whole year. And the way work from home will continue for the rest of this year or the calendar year, because we have declared work from home till end of the calendar year. And also some of the cost savings that came up on account of the pandemic continue to be in the system. So that's something that will surely continue to give the benefits. As far as attrition is concerned, we have reached the lowest point right now. Trailing 12 months is about 12.4%. Yes, there is a possibility that it can go down a little bit more, but I think we have kind of stabilized at the number. And you're right, in a form or fashion, higher attrition could have an impact, and which is why even though we have declared 27% EBITDA for the year, quarter is also about 26.3, 26.4%. I've been guiding between 22 to 24%. But the cost savings, like I said, will hopefully make up for some of those numbers, and we'll hold to these healthy margins that we have shown above the numbers that I'm guiding for the rest of the year.
Joseph, this question is for you. While you have stated that the demand is strong, give us actually more color on the quantum of the deal pipeline. Also, how strong is your deal pipeline?
So, as far as this question came up in the earnings call yesterday as well, we tracked this internally. Overall, I would say that the demand conditions are really good, and what is driving it is, if you look at the US market, in December, customers were sitting on the fence and waiting to see how the whole political situation and the COVID situation will get resolved. And by end of January, the political situation had resolved itself. Things looked fine. And you also had vaccination getting rolled out in a very effective manner and really picked up pace in February. So we saw more optimism coming into the market. And what customers have realized is that two things. One is you have to get into your digital initiatives and implement them to just remain where you are, because your competitors are doing it. And also because your customers and users have got used to this new way of life. So you have to adapt your products and your offerings. The second is, whatever you had planned for 3-4 year time period, you have to pull that back in again to be competitive. So we've seen a real increase, or I would almost call explosion in demand. So that has also reflected in the pipeline improving. We don't really share the pipeline exact numbers because these things tend to be lumpy. You have a $5 million or a $2 million or $10 million deal, and it's binary in nature. It's 0 or 1, and it can really move things. Again, you have to weight it by probability. But overall, I would say that the demand is there for the taking. There's a lot of initiatives being launched in the verticals that we are focused on. So it's led to a strong pipeline.
Venkatraman, this question is for you. The company has declared a maiden dividend of 3 rupees per share. Could you tell us what will be the company's overall payout policy going ahead?
So we have a progressive dividend policy. We follow a progressive dividend policy rather. Year over year, we would try to improve the payment of dividend per share over the past. This is the first dividend of the company, is a maiden dividend. So we have allocated 3 rupees per share, which would be about an outflow of about 44 crores. We are sitting on a cash balance of about 550 plus crores, assuming that we generate an equal amount. We generate 50-55 crores of cash every quarter. We should be in the same place after payment of dividend of 44 crores by end of Q1.
All right, thank you so much, gentlemen, for taking the time, and wish you all the best for the future. Now let's turn to pharma, because that's going to be front and